My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now.
Hey, I'm Cramer. Welcome to a special West Coast edition of Mad Money. Welcome to Cramerica. Other people want to make friends? I'm just trying to make you some money. My job is not just to entertain, but to educate, put it in context. Call me at 1-800-743-CNBC or tweet me at Jim Cramer. We don't talk too much about stagflation. Basically, because it's a curse word in this business. Stagflation means we have an economic slowdown while inflation is still raging. Oh, man, the Jimmy Carter cocktail. A combination so toxic for the stock market that people will pretty much sell everything. And that's what we saw today as the Dow shed 269 points. S&P lost 1.08%, and the Nasdaq dropped 0.73%. Now, personally, I don't believe that we're in for a bout of stagflation. I see an economy that just got too hot and is now cooling off, which is just what the doctor ordered, the doctor being Fed Chief Jay Powell. But today was an out-of-thesis day for me, meaning what I wanted to happen and what actually happened were very much at odds. The Bears had the firm upper hand, and they crushed the market. We know that we're in a bad news is good news situation, where we want the economy to slow down. We're on glut watch. Yesterday, Target told us they had too much inventory and would have to get promotional to unload it. Textbook deflation. We're not sure where they'll sell it, but we know it'll be sold at a lower price than they wanted. That's fantastic for you. And it's one of those things that can reverberate throughout the whole system, given the scale of Target. Sure enough, this morning we got a number of negative research reports arguing that all retail will suffer because of what we heard from Target. Although Target stock itself rallied, which tells me that even the most tarnished stocks can bottom in this environment while the consumer benefits from the promotional activity. Today we got mortgage applications. What a number. It was spectacular for anyone who's hoping to see a decline in the massively overheated real estate market. Mortgage demand fell to its lowest level in 22 years. A casualty of the gigantic jump in mortgage rates of late. While a 5.4% rate is very low by historical standards, it's extremely high versus where it was not that long ago, when prospective home buyers were locking in 2-month mortgages at a 3% and change rate. We know the real estate market is red hot with sky-high rents and a shortage of homes. But with demand falling off a cliff, there could be a housing glut developing, and that, too, is what we want to see. It's certainly what the Fed wants to see to engineer a soft landing for the economy. Then there's this thing called the Manheim Used Car Index, which measures the price of used cars. Thanks to the shortage of new cars in a work-from-home environment where people have migrated away from the cities with public transportation, these used cars, well, they've just shot up in price. But these new numbers from this Manheim Index show that those price increases have decelerated. Used cars were up about 50% year-over-year not too long ago. Now they're only up about 10%. Whatever tightness there may have been is evaporating. So let's see, what do we got? We got household goods going down in price. Yes. Terrific for the consumer. We have mortgage rates crimping runaway housing prices. Yes. And now we might be tackling the last of the intractables, used cars, which, by the way, are a major component of the CPI, which is Friday. 3 for 3. All very good news for the inflation peaking thesis. There's only one problem, and that problem is energy. Specifically, gasoline. It refuses to go down. Price of crude up another 2.5% today, $122. Oil seems to have no ceiling, and that's where the stagflation fears come in. As long as oil prices keep climbing, it's hard to make the case for a soft landing. Oil's a nightmare for the Fed. It reverberates throughout the whole economy, and there seems to be no stopping it. And because oil acts as a tax on the whole system, we could indeed have a slowdown coupled with inflation, and that is that Jimmy Carter stagflation remix. If oil would just go down, I think the Fed would be able to declare victory after doing maybe a couple more gentle rate hikes. But now the runaway price of crude has gone so high that the unthinkable has happened. Even the oil stocks went down. And that brings us to another term of art that we really don't want. Demand destruction. And that's where the price of something goes up so high, so fast, that it sows the seeds of its own destruction. The oil stocks jumped up at first. They opened higher today. Then many dropped because, well, people are starting to realize demand's going to be curtailed. They won't be able to make that much money at those prices. But that doesn't necessarily mean the price of crude will stop climbing because it's a lack of supply problem. Oh, it's not just the oils. We saw a collapse in the freight companies today that we never want to see. The stocks of United Parcel and FedEx just getting crushed. Now, they can pass on that cut to their customers via fuel surcharge, but that won't stop the demand destruction in this important industry. Plus, nobody thinks oil can go in any direction except up. The psychology is so bad, which is exactly what the psychology was like in the 70s when we first got acquainted with stagflation. Now, this time we're not hostage to OPEC. We're hostage to a domestic oil industry that's afraid to drill because the current White House doesn't really have an oil-friendly track record. Putting it bluntly, the Democrats are the pro-environment party. The Republicans are the pro-oil party. These guys know where the bread is buttered, and it's not buttered by Joe Biden. As a matter of fact, we have to believe that maybe the president would rather go to Saudi Arabia and negotiate with them and then talk to the American CEOs who dominate the Texan Permian Basin, our biggest basin, where all the oil is. While it can take a year to site and drill new wells, and we're aware of that, if the president would encourage them and offer maybe some assistance in building much-needed pipelines, I'm confident these companies would do it. By the way, it would also help national security because we get natural gas maybe to Europe. But to get these executives to trust him, Biden would have to cozy up, or at least seem like he is, to the oil industry and stop talking just about renewable energy, something that would infuriate his base. Like most politicians, Biden doesn't want to do that. He's actually made it more difficult to build new pipelines. The stuff that's coming out in the last few weeks is really bad for the pipeline industry. I do believe Biden could placate the oil industry, which has grown more and more responsible, by the way, about the environment, even as they are fossil fuel companies. But Biden would have to throw many of his core supporters to the wolves to make that happen. I think it's a good deal for the president if he can get us lower gas prices by 2024. And he can. This is America. We'd sacrifice anything for lower gasoline prices. Unfortunately, Biden doesn't seem willing to do it. And that's a big reason why energy won't come down. Of course, the other reason is the war in Ukraine, but that's well beyond our control. So why don't we just throw up our hands and admit that oil won't stop going higher, which means we're stuck with stagflation? Sell. The fact that the oil stocks acted poorly today tells me that demand for crude will slow as prices keep climbing. That's why I don't necessarily see stagflation happening, but sky-high oil might translate into a more serious slowdown. Every time crude goes up, so do the odds of a recession. Now, we can even talk ourselves into one looking at the price of crude. Something seems to be happening everywhere I go in San Francisco, young and old, over a mezcal, down the street. Again, I don't believe in the stagflation thesis. Ideally, we can wangle our way out of energy inflation with more supply, not from the Saudis or from electric cars or from windmills or from solar, but the U.S. producers. The bottom line, though, even if we don't get a lot more supply, the price of oil will eventually come down simply from demand destruction. But if it's done that way, we could be in for a miserable, long, hot summer. I say we take calls. Let's go to VJ in South Carolina. VJ!
Good evening, Jim. Thanks for all your advices over the past several decades. I am holding Netflix stock since number of years. What are your thoughts about streaming services stocks and specifically Netflix?
So
Thanks for your time
Netflix
and guidance. Booyah!
Well, booyah! And thank you for those kind words for a long-time follower. Look, I think Netflix is fine. I'm not crazy about it. I don't think it's bad. To me, the cheaper one is Disney because they got Disney Plus, which is another streaming service. Disney just has to get better at telling its own story. I would actually tell you that they're terrible at it. All right, let's go to Pete in Illinois. Pete.
Booyah, Jim.
Booyah, Pete.
Hey, I really need your help here with a stock that you recommended for us for the investment club in early January. So it's fallen 20 to 30% from its high, despite having some positive Q1 earnings as well as several upgrades. So is this just a wrong stock for this kind of market at a 30 PE and a de minimis dividend? Or is this the time to buy right now to propel it, to be ready to propel for when that goes up? And what kind of a catalyst would it take to make that happen? The stock is Danaher.
Okay, stock is Danaher. We've been buying all the way down for the Charitable Trust, which anyone who follows, including this gentleman, follows in CNBC Investing Club knows. We really like it here. We know that they're in talks to make an acquisition that would be more life science. It's been kept down because they do have PCR testing, and people think that's going away. You buy Danaher when it's down. That's what you do. That's what you've done. That's what you must always do. I've learned that a long time ago. We've done it a couple times for the Charitable Trust. We're doing it again. I say buy. I am not deterred by the PE there because the growth rate is so spectacular. It's a great stock to buy in a slowdown, and that's why we're doing it. I want to go to Larry in Arizona. Larry.
Jimmy Chill, Larry from Whiskey Row in Prescott, Arizona.
There you go.
San Francisco has been good to you. Maybe you'll run into Nancy and she can tell you how good things are in her town. My call today is on Dave & Buster's. Tell us your thoughts.
Okay, Dave & Buster's had a remarkably good quarter. Remember, people are going out. They want experiences. Fabulous place for birthday parties. That's what I used to do. And I think the stock can go higher still because it's got a very low multiple, and people are going back to Dave & Buster's. All right, look, even if we don't get a lot more supply, the price of oil will eventually come down, but it's probably going to come down from demand destruction. It would be better if we came down because we have more supply. On Mad Money tonight, Snowflake has had a tough run along with the broader tech cohort. But could a blizzard be brewing for the cloud stock? I'm checking in with the CEO. They after forecasting a surprising revenue decline. Could Cisco's post-earnings drop be a sign of what to come? Or is it a classic buying opportunity? I'm talking the company's top brass. And Oakton defends your enterprises from threats, but does it have what it takes to defend itself from the bears on Wall Street? I've got the exclusive with the CEO. So stay with Cramer. Coming at you from San Francisco.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.